Sure. Thank you very much for the opportunity to present our perspective on this. So a lot of my remarks are going to go back to the first panel that discussed the imbalance between supply and demand in the state. And so to begin, I will give you just a short overview of what's going on with the housing market, given that I represent the realtor community. But housing activity in the state last year in 2014 was lowest since the recovery that we had that started in 2009. So at about 8% lower activity, which was not in line with what was going on in terms of job growth and certainly in terms of interest rates and other housing fundamentals, which would lead us to believe that we would have had a stronger housing market. So a lot of the constraint that we had comes from the lack of inventory. So not only on the existing inventories side, but also on the new home inventory side. So with that, I would like to point out to the report that just came out last week from Legislative Analyst Office titled California High Housing Costs, Causes and Consequences. And a lot of what I'm going to draw on comes from that report, which highlights that in the state we have been missing about 100,000, on average about 100,000 units per year since 1980, which would today total to about 2.5 million homes that were not built to house the existing population in the state. And so as a result of that, we've had prices that have risen in the state much faster, and Dr. Bostic presented those charts that prices that risen much faster in the states than in our state than elsewhere in the country. Solutions that I'm going to talk about, they require a very comprehensive approach, and it requires us to look at all the current policies, including the CEQA, including the development costs, including the review times, the local government finance structure. So we should look at all those in total and put them all on the table in order to have some effective conversation. But I'm going to just highlight some of these issues and then what solutions could possibly be. So one of the issues is the high development costs. We have among the highest land costs in the country. The estimates range between twice as expensive to about 4 times as expensive. And then usually when land costs are expensive, those would be offset by denser development. That's not the case in California for many reasons. Some of them are zoning issues. Some of them are local NIMBYisms, NIMBYs groups, local government funding structure, again, cost, and then general disdain for higher density housing in the state. And then not only that the land costs are higher, building costs are higher. An interesting stat is that California metros are between $50,000 to $75,000 higher to cost of building a typical home is higher than the rest of the country. Also, development fees are higher, the impact fees. So solutions would require streamlining of the processes, which have become too cumbersome and expensive, and then as well expediting the approvals and ensuring lower costs of entitlements and lower impact fees. There should be also some accountability system which would be used to identify the bottlenecks into the development approval processes, and then also, but not to blame everything on the high development costs. There are other issues as well, and I did mention local resistance to new housing. We have a very high degree of voter involvement in land use decisions, and more often than not, local residents vote against the development. So the solution would, to some extent, be to limit the ability of local residents to excessively delay the development process, and also to pursue litigation against developers, which then, in return, increases the cost so much as well. Another issue is California local government structure. Cities and counties do have greater incentive to approve non-residential development and lower density development. So consequently, many cities do opt out to orient and land use development to disproportionate towards these types of development. So the solutions would be to change the incentive structures that are financing cities, including the financial incentives, the zoning requirements, enforce housing elements of general plans, and create incentives to comply. Because currently we do have housing element in the general plan, but that's rather considered rather useless, and localities choose to ignore it oftentimes. So there would be a need to revisit the way we approach this, and to some extent incentivize the localities to get them to meet the housing need requirements. And one other thing I would mention is that during the housing bubble in California, the coastal area, the building in the coastal areas remained flat, while the new construction was primarily driven by the construction in the Inland Empire and the other inland states areas. So, but the demand for housing is primarily in the coastal areas. So, highly desirable areas, coastal communities also have high growth control that limit the number of homes that can be built. So revisiting those growth controls would be very important in order to increase new construction in the highly desirable areas. Also, project reviews along coastal areas are often slow and cumbersome, and so while I can mention a number of review departments that review projects, it would be important to streamline again and expedite the process and identify those bottlenecks. And then there is CEQA, which we did mention earlier, that is significantly delaying the building process, and the report identified that around 2 to 3 years it takes to approve a housing project that's required to have an environmental impact report, which a lot of them do, and then as a consequence the developers either choose not to build or they reduce the size and the scope of the project. So one thing, again, is to fully reevaluate CEQA requirements, and CEQA was passed in 1970. A lot of things have changed since, including car emissions and parking requirements and those sort of things that would be the easiest and most effective way to increase development right away. Another solution is to, we often talk about a lack of developable land in the state, but there is a great potential of infill development. Unfortunately, zoning is very complex across localities in the states, and it's very multifaceted. And again, the zoning zoning laws have often go back to 1970s when things were a lot different. And for example, a dissertation by a UCLA student showed that Los Angeles rezoning or downzoning effectively decreased the capacity by 60%, from 10 million residents that would have been able to live in the county to 4 million residents. And one of the so to go, I think talking about, we don't talk about enough about repurposing and reuse of existing capacity, and so the reason why that is important is in one of the recent analyses that Realtor.com did, where they looked at the traffic by different age groups. They saw that millennials are mostly interested in highly urbanized areas, where the places that, or the areas where they have the most inventory, are not the areas where millennials are interested in living. So, so reevaluating the zoning and ability to redevelop in these urbanized areas is very important. And redeploying these real estate assets in downtown, for example, would be a great great way to solve the first-time buyer problem. And then there is, again, Dr. Bostic mentioned upzoning and generally around transportation corridor. There are good examples in, for example, Washington, D.C., where Arlington County and Montgomery County used density bonuses and various public-private partnerships in order to provide affordable housing. And then one of the simplest solutions, and that has been discussed numerous times, for example, in LA, is to convert unlawful granny units and then allow them to be built more rapidly at a lower cost, because currently some evidence suggests that costs are extraordinarily higher than the actual cost of building. So thank you very much.
Thank you, Dr. Hepp. Mr. Leonard.
Yes, thank you, Chairman DeBobne, Chairman Chow, and members of the committee for inviting me to participate in today's hearing. My name is Paul Leonard. I'm the California Director of the Center for Responsible Lending, and let's see if we can figure this out. The Center for Responsible Lending is a national nonprofit organization. We're affiliated with Self-Help, which is one of the largest national community development financial institutions in the country. We have a mission of trying to build wealth of low-income individuals and communities, particularly people of color, women, rural residents who are traditionally have a more difficult time accessing credit in mainstream financial marketplace. We've, as an institution, have made over $6 billion in loans to almost 70,000 families, going back to 1980. In 2008, we received a federal credit union charter and now operate 20 credit union branches around the state here in California. And one of our products is mortgage loans, and we made about 260 mortgage loans, averaging about $150,000, overwhelmingly first-time home buyers, low moderate income buyers, and overwhelmingly Latino in markets concentrated in Modesto, Bakersfield, Vallejo, where we have our branches, among other places. So CRL has been around since 2006. We've been here talking to members of these committees for years, particularly around the mortgage foreclosure crisis, also working on predatory lending and consumer lending, and are shifting our focus to access to credit issues, particularly, again, for underserved markets. If I can just skip down, wanted to sort of start with the frame here, which is the main frame that we have is that there's really been this overcorrection in lending standards. The Urban Institute recently put out an analysis that said in 2013 there were 1.2 million fewer purchase loans originated nationwide in 2013 than we would have had if we had had normal standards, which were essentially baseline to 2001. Of that 1.2 million, 300,000 fewer were here in California. Just one other point I wanted to make here is that this is disproportionately eliminating minority households from the home purchase mortgage market. And these are a couple of examples, and I've got some more slides that are in my supplemental materials, but these numbers are really striking. From 2005, which was a particularly high year, a lot of predatory lending going on, to 2012, you see dramatic reductions in the mortgage market share for Latino borrowers and for African American borrowers. And I think, so that's the sort of critical framing of my comments today. Overview is, I believe that federal policy levers are the most important, and I think that as chairs of the committees here in California, you guys can play an important role in trying to impact decisions that are being made at the federal level, both in Congress and by regulatory agencies. For state priorities, it seems to me, key focus is on affordability, which means down payment assistance, which means the Cal HFA and other state organizations should be targeting deeper those who have been most impacted by the mortgage foreclosure crisis. States should be financing housing counseling assistance, both pre-purchase and post-purchase counseling. And then perhaps there really is nobody leading the conversation about home ownership here in California, particularly for folks who are underserved. And so I think there's an opportunity at the statewide level to convene the stakeholders, whether it's lenders, whether it's builders, whether it's other advocates, to sort of really tackle what are the issues that are confronting the lack of lending that's going on especially for affordable home ownership. First and foremost, and I haven't heard as much here today as I would have expected, and the context point is the overall performance and the macroeconomic activities of the economy are critically important. Widening income inequality, wage increases, building on the income side is critically important for making sure that more borrowers can qualify to become first-time home buyers. It also reduces negative equity. As I said, the scale of the program, and I thought Mr. Collins from Wells Fargo this morning made the point quite clearly that for first-time home buyers, to reach scale, you have to look at what's happening at the federal level, that the affordable housing programs that are discussed and important and should be considered here are much more narrowly targeted and can't reach a significant degree of scale. So FHA, what's happening at the GSEs, Fannie Mae and Freddie Mac, preservations of the Dodd-Frank consumer lending protections are all critical federal policy issues which California has a keen interest in preserving. My point to the scale, FHA, this is FHA purchase loans in California, and what you see here is that by the mid-2000s, FHA was virtually not present here in the purchase mortgage market. That was for two reasons. One was the lower loan limits, as has been discussed. The second was the rise of subprime lending, and all of FHA's borrowers were essentially being taken away by predatory subprime lenders who were offering loans that were, in effect, too good to be true. But you see back in 2000, all the way up to 2013, FHA has had a much larger presence in the market and represented 134,000 purchase mortgages here in California. 80% of those are first-time home buyers. And as a point of focus on the minority borrowers, Black and Hispanic borrowers nationally rely on FHA for 50% of their home purchase loans. You can see that FHA, immediately after the crisis, they, like other lending secondary market entities, shifted their credit box upward, served a much higher proportion of higher credit score borrowers. That is now shifting back gradually over time to where the median is now in the 620 to 680 FICO range. For FHA, and it was mentioned earlier today, lender overlays continue to remain a substantial barrier. That is that while the FHA allows loans to be insured to credit score borrowers with credit scores down to 580, many lenders are adding in their own credit overlays because of the risks for a variety of reasons. They're concerned about indemnification and having to buy back loans that go into default. FHA has paid attention to these concerns and is addressing some of these issues. They have their quality control and quality assurance program is being reformed, and hopefully they're working on that so that there's a clearer understanding by lenders about what will allow FHA to require them to buy back loans. FHA pricing is also an issue. Recently, in January of this year, they announced a 50 basis point reduction in their mortgage insurance premiums. This will particularly help those folks at the bottom of the incomes of the eligibility spectrum afford to become homeowners. This is only offsetting a portion of the increases that happened after the crisis in order to restore FHA's balance sheet. There are also, in Congress today, there are a number of threats and that Congress is looking at policy reforms, loan limits, increasing minimum down payment requirements, setting maximum income limits and price limits, and setting risk-based pricing. All of these issues disproportionately harm the potential for lending here in California, particularly those who are traditionally underserved borrowers. The tight lending standards have also been have really pervaded the Fannie Mae and Freddie Mac lending, and we're only beginning to see the slightest bit of opening up of their lending standards. In January of this year, the average purchaser had a credit score of 755 not in California, nationwide, 755. So even the important step that FHFA has now granted to allow Fannie and Freddie to start offering 3% down payment loans, they're still applying their full underwriting criteria to these 3% down loans, and so the expectation is that those credit standards will still remain enormously tight and difficult for low and moderate income and borrowers of color to be able to achieve access. FHFA is doing a lot under the leadership of former Congressman Mel Watt to address issues and make access a much more fundamental mission-driven mission of the FHFA as a regulator and as the conservator of Fannie Mae and Freddie Mac. They've clarified the representations and warranties, which are the mortgage buyback requirements now. They've approved funding for the first time for the Affordable Housing Trust Fund and Capital Magnet Fund that will put a small share of the mortgage lending revenues from Fannie and Freddie into a fund that will go specifically to target affordable housing opportunities. And they are considering additional changes around their G fees, their pricing, and mandating new affordable housing goals for the first time since the mortgage crisis has taken effect. All of these together are essentially driving Fannie Mae and Freddie Mac to have more of an affordable housing mission than they've had since the crisis arrived, and that's a step in the right direction. There also continue to be major threats. We worked very hard in Washington to ensure that the Dodd-Frank regulatory reform bill established some new baseline standards for safe lending in the marketplace, none of which is more important than the qualified mortgage ability to repay requirements. There continue to be threats even today. The House Financial Services Committee is marking up a series of bills that would create new loopholes and exceptions to the qualified mortgage lending standards that we think are a step in the wrong direction towards opening up the kinds of risky lending that we saw during the crisis. From a state priority perspective, down payment assistance is critical for CalHFA. I was looking at CalHFA data. They are going to finance about 4,000 mortgages this year, give or take. Average credit scores for some of those borrowers, while the incomes are around $60,000 on average, the credit scores for their Fannie Mae loans are at 720. And the credit scores for their FHA loans are at 680. Those are really still very, very high credit scores, even for those lower income borrowers who are being served. And again, if you look at the folks who were harmed most through the foreclosure crisis, some through no actions of their own, having that high of a credit score is going to be a substantial barrier to access. And we believe CalHFA should be pushing down their targeting further. The state has never directly invested any funding in counseling resources. Except a small portion through CalHFA. But in terms of general fund appropriations, nationwide, the federal appropriations for HUD housing counseling is $50–60 million nationwide. Nationwide. California could absorb that kind of funding with our HUD housing counseling network easily. Not that we need that much to start out with, but in times in which the budget we're getting a more stable budget situation here in California, a small investment in housing counseling would be an investment that would be very well spent and very concrete. Finally, as I mentioned, for a state priority, beginning to have the conversation about what it's going to take to get more lending targeted to underserved borrowers with counselors, with policymakers, with realtors, with the executive branch representatives and members of the Assembly and the Senate, I think would be a constructive exercise. There is no single point of contact for leadership on affordable home ownership opportunities. Rightly, I think that most of the oxygen here in Sacramento is focused on affordable rental. I think that's a good decision. But there are many opportunities in many markets around the state where borrowers can access more affordable mortgages than they can rental costs at this point in time. And while we've missed out on a great opportunity for allowing lower-income borrowers and lower-income communities to buy in their neighborhoods as we've gone through the foreclosure crisis, we still have plenty of opportunities to figure out how we can maximize those resources for low and moderate-income communities and borrowers of color here. And I'll just want to point out there's a bunch of supplemental material in my presentation that addresses more detail about racial disparities, that provides some interesting data and graphics about barriers to access, and that talks about Self-Help's secondary market program, which again has targeted lower income borrowers successfully up until the mortgage crisis, and that allowed borrowers to build wealth during that period, primarily through sound 30-year fixed-rate, well-underwritten loans. Plain vanilla loans, not too wedded to FICO scores, but assuring that borrowers had the ability to repay. And we did that in a way that allowed people to sustain home ownership and build wealth even through the mortgage crisis. And at that, I will end my remarks and turn it over to my colleague, Lori Gay.
Thank you.
Thank you. I'm going to try to keep it brief since I stand in between lunch, I think. And thank you for having me, Mr. Chairman. We appreciate being on the solutions panel. I often say that sometimes solutions should be at the beginning because it's much more inspiring, and I want to thank my fellow panelists. I don't have to reiterate what they've said. It's all been critical. A couple of things about neighborhood housing services. We are Southern California's largest affordable homeownership provider on the nonprofit side, and have been for quite a while. At 30 years old, you reflect. And our reflections include a couple of simple things. Communities matter, neighborhoods matter, families matter, home matters. There is no one single ingredient that seems to be more important to families than becoming homeowners. And for whatever reason, that's still very true in every client intake and every client exit poll. We see more than 20,000 families a year who want to be homeowners. During the foreclosure crisis, we were the nation's largest foreclosure responder, given our coalition in Southern California. 30,000 families a year talk to us. 97% of them did not have a household budget that they lived by. So financial literacy is key, financial coaching is key, financial counseling is key. People don't have a clue about money. They don't know how to use it. They don't know how to manage it. They don't know how to get it. They don't know how to keep it. And talking to them in those direct, detailed formats is what people need. So any support that the state can provide, as Paul mentioned, to supporting the HUD counseling network throughout the state, which is a solid one. You have long-term players. None of us is super special. We're just in our regions doing our work. But they're strong. The money that came through the Attorney General's office on the foreclosure counseling side was revolutionary for most of us because we hadn't seen it. To be able to see it on the pre-purchase side, I think would be exceptional. Some of the ways that might happen, I always have four corners of any room that I speak to. There's people and property, marketing, and money. So I'll start with money. Some of the money that you control that could be helpful. Figuring out a way to restore the Cal Home program. While initiated by bonds, it was one of the most successful over the last 15 years in terms of helping families get into homeownership and stay there. And some of that funding was eligible for counseling as well. The new cap and trade money. Figuring out a way, there's some set-asides for homeownership, but how do we grow that over time in a creative fashion? You were all very intrigued with the Community Land Trust detail today. How do we write some of that into cap and trade? How do we write lease to purchase in? How do we write affordable homeownership modeling into a transit-oriented development discussion? We have to build high-rise or higher-rise units in Southern California for sure. We're not as well built as some of Northern California. I'm from Orville, so I'm a hick. I live in Los Angeles now, but what I understand is that LA is slow growth urban sprawl, and that's got to stop. So around the transit stops, I brought a packet for you that shows a transit-oriented development map. every property within a half mile to 3/4 of a mile should be touched in some way with home ownership. That conversation is not on the table. And I think that the nonprofits who do this work get concerned about speaking up. So that's part of why I agreed to come today, because I know it's critical. We can come up with different modeling on the developer side to be able to accommodate the affordability detail. Other thing I'd say is COIN program. We've been members of that forever. The tax credit program got renewed. Any funding that can be redirected to programs like that is critical, because you have community development financial institutions throughout the state that can then access it, utilize it. It incentivizes banks and insurance companies to invest in those community development institutions so that they can do more work on the mortgage lending side. We have 3 companies we manage at NHS. One is redevelopment focused and licensed as a real estate broker in the state. The other is lending focused and licensed as a mortgage lender. The third is brand, right? Administrative functions. And what we found with all those companies working together to serve families is that we're able to do high volume. Last year, we originated 698 mortgage loans, 638 of them closed. What did our buyer profile look like? African American, 22%. Hispanic American, 47%. Asian American, 14%. Caucasian and other, 10% plus. Those numbers are a huge shift from the pre and during foreclosure environment, where we had 47 and 48% African American and Hispanic American as our first-time buyer. What happened? Blacks die or they fly. Meaning, black flight has happened so substantially in the community we serve that people want to live in other portions of the county. They want to live in the marina. So the millennial discussion in the paperwork that I reviewed, that is not my customer. At $24,000, $35,000 a year, they're not buying in my county because it's unaffordable. Am I seeing more young people? Yes, but they're generally between ages 30 to 40. Family size 1 to 3. Income 60 to 80,000. That is a very different buyer profile, and they are leading the charge now. Thus, the influx of Asian and Caucasian buyers. So we are watching it. Every number you can ever want, we have it. Why? Because the thousands of people that come through represent the changing and diverse economic nature of who's buying and why. And we talk to them constantly, so we're collecting this anecdotal data that tells us that homeownership's not the main thing for some of the younger public. And that's okay. We can ensure, though, that they're financially literate and that they learn how to manage the student debt. If you were going to figure something out, working around the student debt issue is the most critical underwriting detail that we see. Young people may have some credit smarts, but there's just too much debt. I don't know how to influence our universities to not charge so much. I'm not in that business. But I do think that the point I'm making to you is we can run literacy and counseling campaigns. We can get money that you already control into people's hands if we can figure out how to keep making sure it's there. And then last but not least, on inventory, we've heard a lot about that today. Enforcing existing rules on the local basis might be something that the state legislators can work with local municipalities on. Most of us are buried in that. And what I mean by that is, if they have set-asides for inclusionary housing, do it. If you got a 20% set aside to help people get into a home or buy or rent an apartment, do it. And don't allow developers to come in and just decide or pay off people or whatever they do. I don't want to be ugly. But I'm suggesting that all of us working together and talking about it will help us house more people. And we've got some strength in what we already have in our hands to do it. We can run all kinds of student campaigns if we want more students, but then they get in and the underwriting precludes them from being included. The banks will utilize the Community Reinvestment Act to create product. That's how we were able to originate so many loans. I outsourced most of it, and small to medium-sized banks funded it. It wasn't the big shops. They're focused on other things. We're not a friend of FHA, and it's friends of mine that run it. but we don't encourage it for a lower income borrower because it's a premium tax and it's regressive in our communities. So let's create other product. Let's use state money where we can, and let's get people in some homes because it matters. Thank you.
Thank you very much. Assemblymember Brown, did you want to say something?
I want to say that this has been a most enlightening panel. And I wanted to say that what you do in our community has been a lifesaver for the San Bernardino community. And the neighborhood housing there, that organization is really doing good work. I think that we need to see what we can do to help that model so that we can put more homeowners in homes. Renters are fine. However, it's much more stable if you have homeowners. And people say, oh, you know, people don't have to own a home anymore. I think that that gives them their wealth. That gives us our wealth. And we need to work on more home ownership, and especially in the Inland Empire where the homes are available.
Yes.
And if we can do anything to start bringing up these areas that aren't heated so already. For example, San Francisco, those areas are already so impacted. What about let's look at how we can push some of that to the areas that are not impacted. So
Got it.
that's my 2 cents.
Thanks for your comments. I appreciate it very much, and for staying as well.
Go.
Well, I want to take this opportunity to thank the panelists for being here and for sharing your insights. And by the way, the hearing has been televised, so we, in the event that any of the members who are not here, need to catch it, they will be able to do so. So with that, I want to thank you again for being here, for joining us. And you have proposed a number of solutions that we like to follow up on, and we will be contacting your office if we need any more information. And thank you again for being here. That brings us to public comment. At this time, if there is any members of the public who would like to speak, please come on up and form a line. Perhaps I don't see anybody coming up. Well, I want to thank you all for being here, and meeting stands adjourned.